Two traders sit in the same Discord server. Both have access to the same charts, the same news feeds, the same opportunity. David has been trading for 3 years. He's read every book, back-tested his strategy over 500 trades, achieved a 58% win rate with a disciplined 1-to-2 risk-reward ratio. On paper, he should be profitable. His equity curve should climb steadily upward like the success stories promise. But David is broke. Not down a few percent broke. Completely out of the game broke. His prop firm account? Blown. His personal savings? Evaporated. He sits in that Discord server now, silent, watching others celebrate wins he can no longer participate in. Then there's Marcus. Marcus has a 42% win rate. His average winner barely exceeds his average loser. He doesn't post inspirational quotes about discipline. He doesn't share elaborate chart setups with 17 indicators. But Marcus has been consistently profitable for 4 years straight. He trades size that would make David's hands shake. He passes prop firm challenges in his sleep. And here's what will shatter everything you think you know about trading. Marcus thinks like a market maker, and David thinks like a retail trader. And that difference, that single cognitive shift, separates the ones who survive from the ones who disappear. Let me show you the invisible war happening in your brain every time you click that buy button, because, until you understand this, you're not trading the market, you're trading against your own nervous system. And your nervous system is designed to make you lose. David's strategy had a 58% win rate. Run that through any basic expectancy calculator, and you get positive expected value. The math works. The logic is sound. So what happened? What they don't tell you in the YouTube videos and the trading courses is that a 58% win rate doesn't mean you win 58 times out of every 100 trades in a neat, orderly fashion. Variance, the cruel randomness of how wins and losses cluster, means you can have a positive expectancy system and still experience drawdowns that psychologically destroy you before the edge ever manifests. Let's talk about what really happened to David. In month 7 of his trading journey, he hit a losing streak. Not a catastrophic one by statistical standards, just 11 losses in a row. For a system with a 58% win rate, Monte Carlo simulations show this will happen. Not might happen. Will happen. Run 1,000 simulations of 1,000 trades, each with a 58% win rate, and losing streaks of 10 or more trades appear in over 60% of those simulations. David's losing streak wasn't bad luck. It was statistics playing out exactly as they should. But here's where neuroscience becomes your enemy. Every time David placed a trade, his brain's reward prediction system activated. This isn't metaphorical. This is your ventral striatum lighting up on an fMRI scan, releasing dopamine in anticipation of reward. When the trade won, his brain got what it expected. Homeostasis maintained. But when the trade lost, especially after his system told him he should win 58% of the time, his brain experienced reward prediction error, the gap between expected reward and actual outcome. That gap triggers cortisol release. 1 loss? Manageable. 2 in a row? Uncomfortable. 11 in a row? His hypothalamic pituitary adrenal axis was flooding his system with stress hormones at levels comparable to physical danger. By loss number 8, David started making what he called minor adjustments. He tightened his stop loss just by a few pips. He skipped trades that didn't feel right. He added a confirmation indicator. These weren't improvements. These were cortisol-induced survival responses. His dorsolateral prefrontal cortex, the part responsible for executive function and rational decision-making, was being suppressed by his amygdala's fear response. He was literally incapable of executing his strategy as designed because his brain had shifted into threat detection mode. This is learned helplessness in real time. When an organism experiences repeated adverse stimuli, it cannot control. It stops trying to escape, even when escape becomes possible. David's prop firm account had a 10% drawdown limit. His personal risk management rules said never risk more than 1% per trade. Sounds conservative, right? Here's the trap. With 11 consecutive losses at 1% risk each, he was down 11%. He violated his prop firm drawdown limit not through recklessness, but through perfectly normal variance. The prop firm's risk parameters were designed for equity curve stability, not statistical reality. They optimized for marketing screenshots of smooth growth curves, not the jagged, violent swings that come with actually trading a probabilistic edge. Now let's enter Marcus's world. Marcus runs a different operating system entirely. When I say he thinks like a market maker, I don't mean he has special access or insider information. I mean, he's internalized how the other side of his trades actually operates. Market makers don't predict direction. They don't care about direction. They provide liquidity and capture spread. Their profit comes from volume and edge per trade, not from being right. When Marcus looks at a setup, he's not asking, will this go up or down? He's asking, what's the probability distribution of outcomes, and how can I structure this to profit from multiple scenarios? Marcus trades option strategies with defined risk on both sides. He sells premium when implied volatility exceeds historical volatility. He runs delta-neutral positions that profit from time decay, regardless of direction. His 42% win rate exists because many of his trades are structured to lose small amounts frequently while capturing large gains intermittently, the inverse of how retail traders typically operate. But here's the crucial part. His equity curve shows smaller, more frequent drawdowns instead of infrequent but devastating ones. The psychological difference is staggering. When Marcus has a losing trade, his reward prediction error is minimal because his brain expects 42% wins. He's not surprised by losses. His cortisol response remains muted. His decision-making stays rational. More importantly, his wins, when they come, trigger the winner's effect. This is a documented neurochemical phenomenon where success increases testosterone and dopamine levels, which then increases confidence and risk-taking ability in a productive way. But it only works when wins exceed baseline expectations. David expected 58% wins, so hitting 58% felt like breaking even. Marcus expects 42% wins, so hitting 42% feels like a system working perfectly, and anything above that feels like outperformance. Let's ground this in data. Take two hypothetical systems over 200 trades. System: a David's approach wins 58% with an average win of $200 and average loss of $100. Expected value per trade: $32. System B: Marcus's approach wins 42% with an average win of $300 and average loss of $120. Expected value per trade: $56. On paper, System B is superior, but run Monte Carlo simulations on both, and you'll see System A produces longer losing streaks and deeper drawdowns despite the higher win rate. Here's where it gets visceral. System A will experience an average maximum drawdown of 18% over those 200 trades. System B, 12%. Why? Because the distribution of losses matters more than the frequency of wins. System A stacks small losses until they accumulate into psychological devastation. System B spreads losses more evenly across the equity curve. The trader using System B never experiences the prolonged cortisol cascade that destroys discipline. Professional trading firms understand this at a cellular level. Jane Street, Citadel, Optiver, these firms don't hire traders who need to be right. They hire traders who can execute probabilistic strategies with emotional detachment. Their training programs deliberately induce stress responses and measure how quickly traders return to baseline cortisol levels. They're not testing market knowledge. They're testing nervous system resilience. They've learned what neuroscience has proven. The trader who can maintain prefrontal cortex function under stress will outlast the trader with a better strategy, but worse stress regulation. Prop firms market themselves to retail traders with promises of capital and profit splits, but their risk parameters betray their true model. Most prop firms profit more from evaluation fees than from successful traders. Their 10% drawdown limits aren't designed for trader success. They're designed to ensure most traders fail before the firm assumes meaningful risk. It's statistical arbitrage applied to human psychology. They know that even good systems will hit 10% drawdowns through normal variance, especially when traders are risking 1 to 2% per trade. The math ensures attrition. Compare this to how actual proprietary trading firms operate internally. Their traders often have 30 to 40% drawdown limits because the firm understands variance. They're capitalized to weather statistical storms. They've run the Monte Carlo simulations. They know that a trader with a genuine edge will experience drawdowns that would violate retail prop firm limits, and they've structured their risk management around statistical reality rather than marketing aesthetics. David never learned this because nobody teaches it. Trading education focuses on entries and exits, on support and resistance, on patterns and indicators. All downstream concerns. The upstream problem, the cognitive and neurochemical reality of executing a probabilistic system with an inconsistent equity curve remains invisible. David optimized his strategy for win rate because higher win rates feel better. They provide more frequent dopamine hits. They align with our narrative-seeking brains that want to believe we can predict the future. But win rate optimization is optimization for emotional satisfaction, not for profitability or psychological sustainability. Marcus learned his approach the hard way. He blew 2 accounts trading directionally with high win rate systems. Then he started studying how market makers operated. He realized they're not trying to predict anything, they're trying to provide liquidity and capture edge through structure rather than prediction. He started trading like a bookie instead of a gambler. Bookies don't care who wins the game. They care about balancing their book and capturing the spread. Marcus stopped asking what the market would do and started asking how he could structure positions that extracted edge regardless of direction. This shift from prediction to probability management changes everything. When you trade directionally, you need the market to do something specific for you to profit. You're dependent on external outcomes. When you trade like a market maker, you're creating your own edge through structure. You're selling overpriced options. You're capturing bid-ask spreads. You're profiting from mean reversion and time decay. The market's direction becomes less relevant than the market's behavior relative to your position structure. The retail trading world sells you the David model because it's intuitive and marketable. Find high probability setups, manage your risk, be disciplined. It sounds good. It feels good. It aligns with our need for control and our belief that hard work and analysis should yield predictable results. But markets are non-ergodic systems. Past performance doesn't guarantee future results, and time averages don't equal ensemble averages. Your 58% win rate might manifest as 30% over your next 50 trades purely through variance. And if your risk management and psychology aren't built to survive that, your edge is irrelevant. The Marcus model is harder to market because it requires accepting uncertainty, embracing losses as a natural component of the system, and structuring trades around probability distributions rather than directional predictions. It requires thinking in terms of expected value across hundreds of trades rather than the outcome of the next trade. It requires rewiring your reward prediction system to find satisfaction in proper execution rather than in being right. Here's what changes when you make this shift. You stop checking your trades obsessively because you've already defined your risk and your edge exists in the aggregate, not the individual trade. Your cortisol response to losses diminishes because losses were expected and planned for. Your discipline becomes effortless because you're not fighting your nervous system. You've designed a system that works with your nervous system. You start thinking in portfolio terms rather than trade terms. You start optimizing for equity curve smoothness rather than win rate. You start structuring positions that profit from volatility and time rather than direction. David is gone from that Discord server now. Last anyone heard, he was talking about going back to school, about how trading just wasn't for him. But trading wasn't the problem. The problem was he was playing a different game than the professionals while using their language. He thought edge meant a high win rate. Market makers know edge means positive expected value with survivable variance. He thought discipline meant following rules. Professionals know discipline means executing a probabilistic system without emotional interference despite equity curve volatility. He thought success meant being right. They know success means managing uncertainty profitably. Marcus is still there, still trading, still posting his monthly returns, never spectacular, always consistent. He's not a genius. He doesn't have secret indicators. He just learned to think like the other side of the trade, and in doing so, he became the house instead of the gambler. In trading, as in casinos, the house always wins not because they're smarter or luckier, but because they understand probability, they manage variance, and they never bet on outcomes they can't afford to lose. The question isn't whether you can learn to trade profitably. The question is whether you can rewire your brain to operate probabilistically in a world that trained you to think deterministically. Can you find satisfaction in executing a system that loses 40 to 60% of the time? Can you maintain discipline through drawdowns that feel like personal failure but are actually statistical normalcy? Can you stop trying to predict the future and start managing probability distributions? Because that's the real edge. Not your strategy, your nervous system. Master that, and you become untouchable. Ignore it, And you become another statistic, another retail trader who had the right strategy but the wrong operating system, another David wondering why the math didn't save him.